Hello, I'm Liz Lumley and this is Finextra at Sibos, and today I'm speaking to Stuart Clark and Will Cawthorne, both of Impendium, and we're going to talk about the most dreaded word in banking, which is regulations. So, Will, what has been sort of the general attitude to regulations at this year's Sibos?
Well, it's a huge agenda item. I mean, everywhere you go, you're hearing people talk about it. There are huge amounts of events and sessions going on where people are talking about all manner of regulations, whether it be kind of capital adequacy or kind of trade or transaction. You name it, it's on the agenda, far more than I think I've ever seen before. And I think there's a certain amount of frustration about it as well. I think people are now becoming more accepting of it. In fact, I'm going to paraphrase somebody I saw in a session yesterday, Bill Fox from Bank of America Merrill Lynch, who said the regulation, the acceptance of regulation is very much like how you accept grief, and that you first go through denial and then you go through kind of anger, and they've been through those phases. They've kind of gone through depression, although sometimes they're still in that phase, and now they're in that acceptance phase where the kind of regulations start to be ratified. They can see a roadmap, they can see kind of synergies between the global regulators and the domestic regulators in the future, and they can see what they're going to have to do about them. So even though there's frustration, I think far more acceptance, and I think the amount of material, the amount of conversation I'm hearing demonstrate that this year.
I mean, how these regulations are being extended to cover derivatives does seem to be a big talking point at Sibos this year.
So within the derivative space, there's a huge amount of variance between the local regulators. So in the US, you've got Dodd-Frank CFTC reporting, which is focusing primarily on OTC derivatives. The whole implementation cycle and timeline that it's taken for banks to get on side and get on board with that has continually been extended. And then what we're seeing within Europe, within the ESMA framework, is an extension of that. So you're looking at both OTC reporting, but in addition, ESMA is also looking at reporting of exchange traded derivatives. They're making it even more complex by asking for detailed life cycle events, which is not so much required within the US. And then when you go out to Asia Pacific, who are gradually playing catch up, they're looking at a hybrid of the two. So when you look at AIC reporting, when you look at HKMA reporting, they're all doing different flavours of this kind of derivatives reporting. So it's a very complex and convoluted process, and the regulators aren't necessarily helping themselves because they're pushing back deadlines. There's not clarity around things like unique trade identifiers, unique product identifiers, legal entity identifiers. The whole thing just gets more and more complicated. And I think the regulators are realising that, whilst they want to do something in a certain way, the actual practical reality of the market being able to adopt and embrace that is really, really quite difficult to do.
Yeah, it's very hard to get banks to admit that there's a certain amount of global fragmentation with regulations. So, I mean, how big an issue are these sort of local and domestic differences with regulatory mandates?
So, depending on the organisation, the bigger the financial institution, the bigger the bank, the more countries they deal with, and actually having almost a regulatory brain within the firm becomes more and more complicated. And one of the drivers for that is that traditionally business groups have worked in isolation, in silos. So the head of the FX business will have an agenda, will have a remit, and they'll be looking at certain things, certain regulations. The head of equity derivatives, with his own P&L, with his own budgets, with his own agenda, will be looking at something completely separate. So even within a location, even within a country, you get disparity. And trying to get, banks are really struggling at times to get the central management, the COO layers, to actually get these business heads to actually work together. Because we've seen from the number of fines that the regulators are now beginning to issue, that they're insistent that these organisations actually meet the requirement, and it's trying to get these business heads to actually work collectively, because if they don't, they won't be able to trade. So ironically, if you're a small organisation just trading in one location, you're almost better off because you just need to meet the requirements of one particular regulator. Conversely, we're also seeing a huge amount of change with non-financial, so large energy companies, large utility companies that have never been necessarily regulated or never had to provide information to a local regulator about their transactions and their trades. So for example, things like REMIT, for example, energy trading within Europe, if they're not caught by the EMIR derivatives regulation, they will be caught by this energy reporting, and that's for both physical delivery as well as exchange traded contracts. So suddenly they're having to really focus on the fact that they've got to be able to take all of their different energy exchanges, all of their physical trading, all of their OTC contracts, bring all that information together and actually report it to a reported mechanism to then actually get the data to the regulator. So it is a fundamental step, not just for banks across jurisdiction, but also countries within Europe, shipping firms that trade globally have all suddenly got to start almost acting as very regulated, very automated organisations.
I mean, you mentioned this term, the regulatory brain, and Will, you gave us a rundown of how people are discussing regulations at Sibos. What do you think has influenced kind of this change in perception?
Yeah, the driving kind of perception change, I think, with regulation, I think can be boiled down to about two things. And I think firstly, and almost kind of obviously, I suppose, it's the enforcement actions that have been issued against financial organisations around the world. I think if you look at the enforcement actions over, say, the last kind of 18 to 24 months, I mean, some of them have been really, really significant. And only this week, during Sibos, we've seen some new kind of enforcement actions issued in the hundreds of millions. And to kind of paraphrase another conversation I had yesterday with somebody, one chief operations officer came to me and said that that compliance was having a massive impact on his P&L, but on the wrong side. And I think when that starts to happen, people start to take notice. I think the second big thing as well is actually over the last 12 months, particularly since Sibos last year, people have actually tried to implement regulatory solutions, or they've actually started to look at how they're going to action these things, what the impact on their bottom line is, and even what the impact on the kind of business structure of their organisation is. And as they've started to realise exactly how much impact that's going to have, I think it's made people sit up and take a bit more notice about how they're actually going to address some of their obligations.
So, I mean, do you think there's anything missing from the compliance conversation?
I think that's a great question, because I think we've heard a lot about how people are going to do things, and we hear a lot about automation, and we hear a lot about not being able to just throw people at the problem. And I think they're all the right things to hear. But some of the things I'm not hearing so much about, and I'm interested that I haven't heard, is about how to reuse that data. So to meet your regulatory obligations requires a huge amount of data, be it trading, transactional, balance sheet, financial, capital adequacy, etc. It all comes back to data. It comes out of data out of systems that potentially has never been exposed before. And I think I'd like to see a lot of firms actually thinking about how they could use that data as potentially turning something which is a negative P&L, to kind of paraphrase the conversation I had, into a kind of positive. Can I use this for my clients? Can I use this for my own customers? Can I look at this, look at my business in an entirely different way by looking at the data and using it in a different fashion, potentially data that I've never seen before?